The Bank of Canada is holding its policy rate steady at 2.75%. It's the third straight time the central bank has left its key rate unchanged as it waits for more clarity on how Canada's tariff dispute with the U.S. will affect inflation and the economy. The U.S. Federal Reserve will also make its latest interest rate announcement this afternoon. Well, the Bank of Canada Governor Tiff Macklem is speaking right now to the media after keeping its key interest rate unchanged for a third time.
Of underlying inflation pressures. Aujourd'hui, le conseil de direction a maintenu le taux directeur à 2,75%. Cette décision reflète trois grandes considérations. Premièrement, l'incertitude au sujet des droits de douane imposés par les États-Unis au Canada est encore élevée. Les discussions entre les deux pays sont en cours et la politique commerciale américaine reste imprévisible. Deuxièmement, même si les droits de douane américains perturbent le commerce, l'économie canadienne montre une certaine résilience jusqu'à présent. Et troisièmement, l'inflation est près de notre cible de 2%, mais on voit des signes de pression inflationniste sous-jacente. Today's interest rate decision is accompanied by our July monetary policy report. And as in April, we decided not to present a conventional forecast for growth and inflation. U.S. tariffs are still too unpredictable to be able to provide a single forecast for the Canadian economy. So we present three scenarios. The first is what we're calling our current tariff scenario, and it represents a view of how growth and inflation would evolve if the trade arrangements currently in place or agreed were to remain. The two other scenarios examine how things could play out if tariffs escalate or if they de-escalate from where they are now. These three scenarios are designed to capture the uncertainty around U.S. trade policy. There's also uncertainty about how businesses and individuals in Canada and the United States will adapt to this new trade environment. The increases we've seen in U.S. effective tariff rates are less than what was threatened, but they are still outside post-war historical experience. So in addition to using scenarios to help guide monetary policy, we've stepped up our regional outreach to help understand the impacts of tariffs and uncertainty across the country. And we're adding questions to our surveys of Canadian households and businesses. I want to underline that the lack of a conventional forecast does not impede our ability to take monetary policy decisions. But the unusual degree of uncertainty does mean we have to put more weight on the risks. We're looking at over a shorter horizon than usual, and we are ready to respond to new information. So let me provide some details on what we've seen since June. Some tariff agreements have been negotiated between the United States and its trading partners, and that has reduced the risk of a severe and escalating global trade war. Unfortunately, the tariffs in those agreements also suggest the United States is not returning to open trade. So far, the global economic consequences of U.S. trade policy have been less severe than feared. U.S. tariffs have disrupted trade in major economies, and this is slowing global growth, but less than many anticipated. While growth in the U.S. economy looks to be moderating, the labor market has remained solid. And in China, lower exports to the United States have largely been replaced with stronger exports to other countries. In Canada, we had robust growth in the first quarter of 2025, mostly because firms were rushing to get ahead of tariffs. In the second quarter, the economy looks to have contracted as exports to the United States have fallen sharply, both as payback for the pull forward and because tariffs are dampening U.S. demand for our goods. Growth in spending by Canadian businesses and households is being restrained by uncertainty, and new U.S. tariffs are having profound impacts on directly affected sectors. A number of economic indicators suggest that excess supply in the economy has increased since January. Nevertheless, the Canadian economy is showing some resilience so far. A number of surveys suggest consumer and business sentiment is still low, but it has improved. And in the labor market, we're seeing job losses in the sectors that rely on U.S. trade, but employment has kept growing in other parts of the economy. The unemployment rate has moved up modestly to 6.9%. In our current tariff scenario, growth resumes following the second quarter contraction. GDP growth is about 1% in the second half of this year as exports stabilize and household spending increases gradually. The scenario then has growth picking up further in 2026 and reaching close to 2% in 2027, although the path for GDP is permanently lower owing to tariffs. Turning to inflation, CPI inflation has been pulled down by the elimination of the carbon tax and is just below 2%. However, a range of indicators suggest underlying inflation has increased from about 2% in the second half of last year to around 2.5% more recently. This largely reflects an increase in non-energy goods prices. Shelter cost inflation remains the biggest contributor to CPI inflation, but it continues to ease. Surveys indicate businesses' inflation expectations have fallen back after rising in the first quarter, but consumers' expectations have not come down. In the current tariff scenario, there are a number of offsetting upward and downward forces at play, which we outline in detail in the Monetary Policy Report. If I try to boil it all down for you, there are reasons to think that the recent increase in underlying inflation will gradually unwind.
We've been listening to Tiff Macklem, Bank of Canada governor, speaking to the media after keeping its key interest rate unchanged for a third time and discussing some of the reasons behind holding the rate steady at 2.75%.